Hi everyone, Eric from Traders Helping Traders here with this week's Tricks of the Trade. This week we're going to take a look at moving averages. Moving averages are one of my favorite trading tools. As you know from the manual, I like to follow the 5, the 20, and the 55-day moving averages. The 5-day moving average represents the last 5 trading days or gives you an approximation of the weekly trend. The 20 moving average approximates the monthly trend, as there are approximately 20 trading days in a month, and the 55-day average approximates the quarterly trend. Now what's interesting about the moving averages is that I will use the moving averages to help give me a directional bias in my trades. The 20-day moving average, which is this pink line, usually determines whether I'm looking to buy or sell. Since this is the monthly trend, I usually try to trade with the trend, and if the market is trading above the monthly trend, as it is in this case, I will be looking to buy the market long. The shorter moving average, the 5-day moving average, will also help give us a directional bias, but it will also give us buy and sell signals, or not really give us buy and sell signals, but confirm our buy and sell signals. So let's take a look. Let's forward this chart a few days and let's see what happens. You can see that the market came down, hit the 20-day moving average, took a little bit of a bounce off of there because the 20-day moving average is a very strong line. And I'll also show you how the 20-day average roughly approximates the trend line. You can consider the 20-day moving average almost like a moving trend line. Now notice what happened here. The market, after bouncing off the trend line, found resistance and has reversed. Now we're technically looking to sell this market because we are technically short the monthly trend, but we're still long the quarterly trend. So you can see how the moving averages gives you both the short term, the mid-term, and the long term all on one chart. Here, the shorter 5-day moving average, or the weekly trend, has crossed over the monthly trend. So now this indicates to us that there may be a change in the overall market direction. These are one of the things that I like to look for. Here the market continues to trade lower, still hovering around the 20-day moving average, and now we get the big decline. So the market took a dip below the 20-day moving average. The faster moving average crossed over the slower, and now prices fell off. And notice where they fell off to. They fell off right to our long-term moving average line. From here, we get a little bit of a bounce, and notice how quickly the moving average, the 5-day moving average, comes down to cross over the quarterly average. And now we are in a very bearish looking market. You can see how we have support formed here, old resistance back here, new support here, and our moving average lines are showing us that this market is rather bearish. So we could look at selling this market short on a break through this support line and be fairly confident that the move will be sustained. And as you can see, that's exactly what happened. And notice how many times the market came back to our 20-period moving average. And remember how I told you it was like a moving trend line? Look at how the market bounced off of the 20-day moving average all those times. So incorporate moving averages into your trades, into your analysis. It will help you determine which markets are actually trending and in which direction you should be looking to take a position in those markets. And that's this week's Trick of the Trade.